All right, this is Ubedo on behalf of V Electronics, and in this video, we're going to be talking about your adjustable variable mortgage rates. Okay, now your adjustable variable mortgage rates are different than your fixed rates. Okay, so you have fixed rates. These rates allow borrowers to pay a fixed amount of interest, no matter the economic condition, no matter the decisions made by the banks, okay, no matter the decisions made by the central bank, okay, so on and so forth. So these are fixed rates such as 5%, 8%, okay, so on and so forth. So if you're paying 5% on your mortgage, okay, you will end up paying 5% for the rest of its term. Okay, that would be your fixed rate. However, okay, these fixed rates are not always profitable for the banks. For the banks, okay, they're not very profitable. The reason why they're not profitable is because when the interest rates go up in the market, okay, let's say the economy is not doing that great, okay, and there is inflation within the economic system, as a result of which the central bank decides to raise the interest rates. Now, when they decide to raise the interest rates, okay, what's going to end up happening is, okay, the commercial banks are going to be stuck with mortgages and loans at a low interest rate, because we know that banks, they tend to borrow short and lend long, okay, which means their mortgage period or mortgage term is usually between 10 and 30 years, for example. Okay, as a result of which, if they're stuck with a low interest rate for 30 years, they're not making as much money as they would if they had variable rates. Okay, now the variable rates on the other side, as the name suggests, they change. So your adjustable variable mortgage, basically what ends up happening is initially you end up paying less because for a short period there is a fixed term, just like your fixed rate. Okay, this is for a short period. However, as you move forward, okay, in your mortgage term, okay, you will have a period when you will end up paying a variable rate. Okay, and this variable rate is based on a benchmark. Okay, it's based off a reference point. Okay, now when we say reference point, we're talking about things like your prime rate, as well as your overnight secured overnight rate. Okay, so your prime rate, okay, takes a hit every time the central banks decide to bump the interest rates up or down. Okay, so your prime rate is directly proportional, okay, to the interest rates, okay, set by the central bank. Okay, so basically when the interest rates go up because of inflation, okay, your prime rate will go up as well. Okay, which means that based on this prime rate, okay, the variable rate for your mortgages will go up. Okay, which means you'll end up paying more for your mortgages. And when the interest rates go down, let's say to boost the economy, when there is a recession, okay, the prime rate will go down as well. It will be reduced, as a result of which your adjustable variable mortgage rate will be reduced as well. Okay, however, when the interest rates do go up, it's a win-win for the banks, but it's not very convenient for the borrowers. Okay, because the borrowers will end up paying more than the fixed rate. Okay, so that has to do with prime rate. And again, prime rate is based off your interest rates or federal funds rate, or the monetary policies imposed by the central banks. On the other side, you have your secured overnight rate. Okay, now this is similar to your federal funds rate. However, there are big differences, okay, when it comes to your secured overnight rate. Your secured overnight rate is used as a reference point. It's not necessarily the same as your federal funds rate, okay, which is the rate at which commercial banks, they borrow money from each other. Okay, so secured overnight rate is used as a reference point. Okay, it's usually high in volume, okay, which means the transaction is high in volume. We're talking about billions and trillions of dollars, for example. Okay, and the risk is low compared to your federal funds rate. Okay, now as the name suggests, it's also secured by treasuries. Okay, when it comes to your overnight rate, okay, your overnight rate is secured by treasuries, as a result of which this is called secured, and the other one is called federal funds rate, which is basically unsecured. All right, so these are the main differences between your federal funds rate and your secured overnight rate. And these are two ways. Number one is your prime rate. The other one is your secured overnight rate. These are two ways the banks, the commercial banks, they adjust their variable mortgages. Okay, when and after, your fixed period ends. Okay, so a portion of your term will be fixed rate when it comes to your adjustable variable mortgages, and a portion will be a variable rate. And the variable rate will be based off your prime rate and your secured overnight rate. So that will be it for this video. On behalf of V Electronics, this is Ubaid. Have yourself a great day.